Hello, everyone, and a very warm welcome to today's cryptocurrencies update for Friday, January the 19th, 2024. Is it bounce time, my friends? Let's have a look at the charts, see where this potential bounce will top out, and what then the next downside targets will be. Because remember, corrections always move in three waves A, B, C. If this is indeed a second wave, as we prefer it to be, then it is either a flat or a zigzag. Please go to my website under education, click on Elliott Wave, and you will find the difference between these two patterns. We don't know beforehand how this is going to fill itself in. If this is indeed a second wave, cannot be a triangle. Triangle, flat, and zigzag are the only three corrections we have. Those can, of course, become complex. We can have a double zigzag. We can have a irregular flat. We can have a running flat. We can have an expanded flat. And those can be regular or irregular. And triangles can be ascending, descending, double and triple as well. So there's a lot of different corrections out there. And that's why corrections are so difficult to track and trade. Moving on then to the charts and see what we have. So far today, we have a decent intraday reversal. That is a first good sign. And the reason I think we have the potential here for this A wave is we have slight positive divergence on the RSI 5, meaning we went lower on less strength or improved weakness, quite oversold. And right here at the 38.2% retrace, which is at 39.791. So we got pretty close, off by about $400, $500, $600. So there is enough now in the chart to suggest the bounces in the works. What do we need to see to confirm? Well, of course, the first level is to retake the 50-day simple moving average. Okay, that is the first warning for the bears, and it is right there. And then, of course, we need to retake the highs from the week right there, which is the 23.6% retrace. Okay, so the second warning, we'll put it a little bit higher. This is the third warning for the bears, which is a 76.4% retrace. Normally, B waves tend to stay within that parameter. So if we go above it, it's a further indication that this second wave might have already completed, or we get a irregular B wave and then a quite strong C wave. And of course, above the recent uptrend high, things could still be this irregular B wave, but we then prefer to look already for wave 3. So once wave 2 is complete, we get, of course, wave 3 right there. And wave 3 should bring us very close to the all-time highs later this year. Remember, our forecast earlier this year was for a weak Q1. So far, so good. It's pretty weak. Q1 is, of course, not over. We have still 2.5 more months to go. But this looks pretty decent also from a timing perspective. So I expect a decent bounce. The alternative remains that this was only red wave 4. We're going to go to red wave 5 at about 53,000, 56,000, and then we'll see the larger correction. It is still possible because that would allow us still for some weakness into this quarter. Again, look here where we bottomed. We've bottomed here once, twice, 3 times. This is now the 4th time at around 40,000. This is, of course, the defining line in the sand. If we break below today's low, I don't think this is a red wave 4 anymore. So we'll keep this line here, right there. Okay, so that is now the first warning for the bulls. If we go below that one, well, let's put it like that. That's the ultimate warning for the bulls, right? We gotta go and hold that one. Every single time we've held it, that was a good sign. We need to hold it, but you can see how critical that was for the bulls. If we don't hold that one, I think we can rapidly descend into the target zone. So that is our alternative, meaning this is not preferred. We prefer this one. But also, of course, the B wave is looking higher, about $5,000 to $6,000 higher. And of course, the 5 wave is looking higher for about $15,000 higher. So we're going to look higher for now, unless we break below today's low. Very simple, unless we break below today's low. Bigger picture-wise, this is still our preferred wave count. So far, so good that we're in green wave 2. akin to here, the 2016 analogy, akin to pretty much what we saw here in 2020. I don't have 2012 on it, similarly. Q1 of the initial bull market is often rough. Note this is log scale, so what doesn't look like much is pretty much a lot, right? Okay, so then the alternative, bigger picture rise, remains the ABC. This won't be proven unless we break below September low from last year. That's it. This is just our bigger picture alternative. This is our insurance policy. This is the one that will prevent havoc to our portfolio, because if we break below 25,000, we can reach 10,000. I would say 12,000 plus minus 2,000. Well, that is still another 50% haircut. Now, let's say you bought here at 40,000, dropping it to 25,000 is already 50% haircut. And then another 50% of 50%, 75% haircut. No bueno. That's when you really want to take your losses and be done with it. All right. That is the prevention of havoc to your portfolio. Ethereum looks also pretty decent, I would say, for a bounce setup. It reached 23.6% retrace. Should now bounce to around, I would say, 2650, and then the C wave. That is our preferred scenario, as long, of course, as today's low holds. So we now expect this to happen, and then this, okay? And of course, the defining line in descent remains today's low. Okay, this is again very close to the 2400 level. It's quite critical. We got to as low as 2412. Okay, so that remains the defining line of descent. It really does. And then we can allow for this B wave and then the C wave. Since I don't know where the B wave is going to top, and I don't know the relationship between C and A yet, can be equal to A, can also be 1.6 times 8, 1.618 times A. I don't know. This wave's two target zone is quite deep, okay, for the C wave. So we keep it as is. And of course, the second wave should normally retrace about 50 to 60% of that first wave. So that matches quite nicely as well, as you can see here. All right, that would be our ideal target zone, somewhere around there. All right, moving on to the alternative is still possible for the accelerated wave count. We did stab below the first warning, but we haven't closed below it. So we can still do the 4-5, 4-5, 4-5 setup. It is still possible. Similar to Bitcoin, this is our alternative. Okay, this remains our alternative, and we're holding, of course, the critical levels. For the bears, we don't want to see above 2590. That is, of course, a warning, just as I outlined in the previous chart here. So above 2590 is serious warning. Then above 2620 is another warning. Above 2650 is the third warning. And of course, above 2720, then I think we have to really look for 3,000 plus on Ethereum. Oh, sorry, at around 2850 plus or minus 50 for Ethereum. All right, so here we have the 1-2-1-2 setup, and then another 1-2, and then 3-4, 3-4, 3-4, 5 as well. Okay, so that would still be in place as long as we hold, of course, above last year's lows. Huh? Why? Because otherwise this 1-2 setup falls through and we don't have it anymore. So this remains our defining line in the sand at around 1500, I believe it was. Right, that is this low here, 1520, this low. The October low needs to hold, ultimately, for the bigger picture to still fill itself in. Because otherwise, we'll deal with this larger ABC wave, and we're going to about $400 to $600 for Ethereum. And that's not what we want to go, right? $600 compared to $1,500, that's another 50-60% haircut. That is quite a lot of losses we don't want to sit through. This remains our insurance policy. So if we drop below 1,500, last October's low, we're going to go to about 600 to about 400 even. Okay, it is still possible. So we have not disproven it just yet. How we're doing on the ETFs. ETHE should also be in a B wave then. It did stab below the second warning, so I prefer now this wave count. Also here, the target zone for the C wave is quite large, depends on where wave B will top and what type of extension or relationship we get between wave C and wave A. Is it equal to wave A or is it 1.618 times A? We don't know just yet, but I think we have here good VIP confluence at around 16 and a half, 17 and a half. So that is, I would say, the area we're going to look for, right? This is nice VIP confluence right there. And from there, we should then launch in a fifth wave, which could be quite extended and go well beyond 25 plus. But for now, we're going to prefer the ABC setup. Similarly to GBTC, also so far a nice strong reversal candle. Okay, I think we have wave A in place. We should now be in wave B, somewhere to, I would say, $40 plus or minus 2. And then a wave C back down to about $31 to $33. This is our preferred path. Okay, let me paint that in for you real quick so you kind of get an idea. With, of course, the usual warning levels for the bears telling us, uh-oh, this is not going to transpire, meaning the C wave is not going to transpire. First warning is, of course, above the initial retrace, the lowest retrace we're going to look for, then the recent high here, and then, of course, above the 76.4% retrace increases the odds, and that's the retrace of this wave A, that this is not a B wave anymore. And then we can even still have an irregular B wave, but then we might already be in this red wave 5, and then all of wave 4 is complete. Okay. Again, the correction can become a irregular expanded flat. Okay. Irregular expanded flat will have wave B here, and we can still have wave C here. That I cannot foretell you. I have no idea if that's going to happen or not. For now, we prefer the ABC path. Okay. Because if we break above last week's high, we're going to go into the mid 40s to low 50s. How we're doing on Mara? Okay, so far it bottomed here in the potential wave 3 in blue target zone. Then a 4 and then a 5 is still very feasible. Okay. Alternatively, this was a very deep, nasty fourth wave. We need to get back above 20 to start to suggest this is not blue 4. Okay, that is, I would say, the first warning for the bears. And then the second warning is, of course, back above support when we broke support here, which is at 22 something, right? Oh, this is the first warning. This is the first warning. We need to get back above 20. And then the second warning is back above broken support. And then the third warning is probably going to be somewhere around here, 26. All right. And then the final warning for the bears, meaning we're not going to see the fifth wave, is, of course, above the all-time high. But that's already, I would say, here above the bounce high. Okay. So that is really, of course, our defining line in the sand. Extremely oversold. Normally, that means just a bounce and then lower prices to get positive divergence going. Similarly for Riot, so far Riot has bottomed right here in the ideal wave 3 target zone, as we had on the chart now for the last week or so, once it broke down below $12, which it had to hold. So we should now be in this green wave 4, and green wave 4 should go to ideally 1136 to 1244, potentially as high as almost $13. So why? Because that is the 38.2 to 23.6% retrace. And here we have the typical Fibonacci-based impulse pattern. So far, we have a 1.5 relationship between wave 3 and wave 1, which is a little odd, but you know, it's okay. It doesn't have to be 1.618. It doesn't have to be 1.3.8. 1.5 is right there as well. So far, so good. So a bounce back to about, I would say, $12 would be really nice, and then potential lower again. So what then are the warning levels for the bears to watch? Well, of course, we break above the bounce high. I would say all things are considered complete to the downside. And where are we going to look for first? All right, bears, what level don't you want to see broken? Well, that would, of course, be yesterday's high. Okay, that's right there. And then the second warning is, of course, if we go somewhere above this level here, right? This is the level 12. That's our second one for the bears. And what would be our fourth warning would be a retrace, as you can see, right to the top here, which is broken support, similar to Marat. And that is at about $13, I believe. Yeah. So these are warning levels to watch for the bears. If we start breaking above each one, odds start to increase. We're not going to go lower. However, it feels like we are similarly to where we were here, right there. So this looks quite similar. 3-4, 3-4, okay, quite similar. Extremely oversold, extremely oversold. So I like it. For now, we'll leave it. I'm going to edit there as well, just to show you, but then maybe a little bit thinner line, so it's a little bit less obstructing of the chart, and then you can see here how oversold things have gotten. So that's what we have for today. I don't want to mince much more words on these charts. I think they're reasonably self-explanatory. Looks all pretty good to me. I think we're in a bounce. So let's see how this is going to develop over the next days to weeks. Again, Q1 should be weak. So far, Q1 is weak. I like it. Everything is still on track for this preferred ABC wave count. Everything looks still good. If you have any questions, never hesitate to contact me regarding these charts. If you have questions about anything else that I don't cover, even the altcoins that I don't cover, please be advised that I will have to charge for my time to analyze things, obviously. But I'm sure all of you are aware of that. Take care, trade safe. Catch you all next week.